There is a pattern that repeats across every major financial transformation in history, and once you see it clearly, you cannot unsee it. It looks like this. An asset or technology develops real utility. Infrastructure is built. Institutional players begin positioning quietly through over-the-counter transactions that do not move the public price, through strategic partnerships announced in language deliberately designed not to attract attention, through custody arrangements and integration work that happens entirely outside the public market. The on-chain data begins to shift, large wallets accumulate, exchange reserves decline, the liquid float contracts. Meanwhile, the public narrative is somewhere else entirely. Retail investors are watching the daily chart. They are debating whether this week's candle is bullish or bearish. They are arguing about price levels that will look completely irrelevant in hindsight. The mainstream financial press is covering something else. The fear index is wherever it is, and the quiet accumulation continues, precisely because the retail attention is elsewhere. Then a catalyst arrives, a regulatory clearing, a legislative passage, a major institutional announcement, an ETF product launch, something that converts what has been building silently into something the mainstream can see and name. And the market moves, not gradually, not proportionally to the size of the catalyst, but violently, because the move reflects not just the catalyst itself, but all the silent structural preparation that preceded it. The people who understood what was being built in the quiet phase are already positioned. The people who were watching the daily chart are reaching for the buy button as the price is already significantly higher than where they were dismissing it. This is not a theory. It is the documented mechanics of how every major financial assets adoption cycle has unfolded. And right now, the XRP market is producing the specific on-chain and structural signals that have historically characterized the quiet accumulation phase, the phase that precedes the visible move. Welcome back. I'm the calm analyst. Today, we decode the mechanics of institutional accumulation, the specific data that confirms it is occurring, and the behavioral dynamics that determine who is positioned when the quiet phase ends. Let's go. Let's start with the mechanics of how institutional capital actually enters a market, because most retail analysis assumes institutions buy the same way retail does, just with more money. That assumption is wrong, and the error is expensive. Retail investors buy on exchanges. They place market or limit orders, they interact with the public order book, and their buying activity is immediately visible in price and volume data. When retail FOMO creates buying pressure, it shows up immediately in the chart. When retail panic creates selling pressure, it shows up immediately. Retail capital interacts with the public market in real time, which is why retail sentiment is visible in real time. Institutional capital operates completely differently. Before an institution deploys significant capital into a less liquid market, and despite XRP's 3 to 5 billion in liquidity, it remains less liquid than the market's institutions typically operate in. It uses over-the-counter transactions. OTC trades happen bilaterally between the institution and a counterparty at negotiated prices. They do not hit the public order book. They do not move the exchange price. They do not appear in the trading volume data that retail participants monitor. This is not a conspiracy. It is a standard institutional practice designed to avoid market impact, the price slippage that occurs when large orders interact with the public order book and move the price against the buyer before the full position is established. Every sophisticated institutional investor uses OTC markets for significant positions precisely because moving through the public market would make the accumulation prohibitively expensive. The implication of this is critical. The public price chart does not show institutional accumulation while it is happening, by design. The evidence appears in different places: on-chain wallet data, exchange reserve flows, and the statistical distribution of holdings, not in the exchange price or volume that most retail analysis focuses on. What does the on-chain data show right now? Exchange reserves for XRP are at multi-year lows. The tokens that are moving off exchanges are not returning at 15% profits. They are moving into custody arrangements, into ODL working capital pools, into institutional treasury positions that have multi-year holding horizons. The liquid float, the XRP actually available for purchase on the open market without significant price impact, has been contracting throughout the period of maximum retail uncertainty and retail exit. Wallets holding large amounts of XRP have been increasing while the velocity of XRP in active circulation has been decreasing. The combination of those two signals, more concentration in large wallets, less movement of the supply, is the on-chain fingerprint of accumulation rather than distribution. Tokens are not being traded actively. They are being held in preparation for something. Now let's run the wallet distribution data with the precision it deserves, because this is the structural imbalance that most analysis mentions without fully explaining its implications. 5.66 million wallets holding fewer than 100 XRP. 2 million wallets holding between 100 and 100,000 XRP. 32,000 wallets holding more than 100,000 XRP. The first number, 5.66 million wallets with tiny holdings, represents the retail base. These are the participants who bought small amounts, who hold primarily for speculative appreciation, and whose collective behavior is driven by sentiment. They buy when momentum is positive and fear is low. They sell when the chart looks scary, when a headline creates uncertainty, when the sideways grinding produces exhaustion. The third number, 32,000 wallets with significant holdings, is what matters most for understanding the supply dynamic when institutional demand activates. And 32,000 is, by any institutional standard, an extraordinarily small number of liquidity providers. Consider what happens when institutions need to build positions measured in hundreds of millions or billions of dollars in an asset where the large holder base is 32,000 wallets, many of which represent the same entities holding across multiple addresses, reducing the effective number further. The institutional buyers are not competing with each other for supply from a deep liquid market. They are competing for supply from 5 million small holders whose selling behavior is driven by retail emotion. Retail does not distribute smoothly under institutional demand. The behavioral pattern is consistent across markets. Small holders hold through the early stages of price appreciation, convinced the move will reverse. Then, when the move becomes undeniable, they sell into momentum. But by then, the price has already moved significantly from where institutional accumulation occurred. The gap between where institutional capital accumulated and where retail emotion eventually sells creates the violent price discovery that characterizes major adoption events. Supply shocks do not happen gradually. They happen when demand exceeds the available liquid float faster than the market can equilibrate, when the retail selling that would normally absorb institutional buying pressure is insufficient to prevent price discovery from moving sharply upward. The wallet distribution is showing you a market where that dynamic is structurally possible at a scale that has not existed previously in XRP's history. Now let's talk about the network effect mechanics, because this is the force that converts institutional adoption from linear to exponential once the threshold is crossed. Ripple has documented relationships with financial institutions across more than 60 regulatory jurisdictions, 7 major governance banks confirmed across 5 continents, BNY Mellon as custodian of RLUSD reserves and first-mover participant in tokenized deposit infrastructure, MasterCard acquiring BVNK, stablecoin infrastructure built on Ripple rails, G Treasury processing $16 trillion in annual corporate payment flows being migrated to on-chain settlement. Each of these relationships is individually significant, but the network effect they create collectively is multiplicatively larger than the sum of the parts. Here is the mechanism. When Bank A integrates with Ripple's payment infrastructure, it gains the ability to settle cross-border transactions with every other institution that is also integrated. The value of the connection is not just the specific corridor Bank A opens. It is access to the entire network of institutions that have already connected. Each new institution that joins does not add one new connection. It adds connections to every existing participant simultaneously. This is why network adoption curves are not linear. They are exponential. The first institution to connect gains access to a network of 1. The 100th institution to connect gains access to a network of 99 existing participants. The 1,000th institution gains access to 999. The value of each successive connection grows with the size of the network, which means the incentive to connect also grows with the size of the network. XRP sits at the center of this network as the bridge asset. Every cross-currency settlement between two institutions on the network has the option to use XRP as the neutral intermediary. Eliminating the bilateral pre-funding requirement, and the 27 trillion in frozen nostro and vostro capital it creates. As the network grows, the number of settlement pairs that benefit from XRP as a bridge grows as a function of the square of the number of participants. 100 participants create approximately 5,000 settlement pairs. 1,000 participants create approximately 500,000. 10,000 participants create approximately 50 million. Each of those settlement pairs has the potential to use XRP as a bridge. The demand for XRP as a bridge asset does not grow linearly with institutional adoption. It grows with the square of the network size. This is the mechanism that converts a seemingly gradual adoption curve into an exponential demand event when the network crosses its critical mass threshold. Now let me address the regulatory timing overlay, because the permission problem we discussed in previous analysis intersects directly with the network effect and supply dynamic in a way that makes the current moment structurally distinct. The SEC CFTC commodity classification issued on March 17, 2026 removes the primary compliance barrier that prevented U.S. institutional capital from deploying into XRP-based infrastructure at scale. The Genius Act has created mandatory bridge asset demand from stablecoin proliferation. The Clarity Act is approaching summer passage with 76% prediction, market probability of passage by mid-2026. Each of these regulatory developments is not just a positive signal. Each one specifically removes a barrier that was artificially constraining the network effect. U.S. institutions that have been ready technically but constrained legally can now connect to the network. U.S. exchanges that delisted or restricted XRP during the lawsuit period can now relist it. U.S. ETF products can launch and provide institutional mandates with regulated access. The network effect curve has been suppressed below its natural trajectory by regulatory barriers. When those barriers are removed, the curve does not resume from where it was suppressed. It accelerates to catch up with the trajectory it would have followed without suppression, then continues from that level. The institutional relationships that were built during the suppression period activate simultaneously when the permission arrives. The Clarity Act's summer passage is not just one more regulatory milestone. It is the statutory codification that converts all the preceding guidance and interpretation into permanent law. The foundation that allows institutions with the longest compliance horizons and the most conservative legal teams to deploy at full scale. When that statutory foundation is in place, the 3 to 5 trillion in documented waiting capital does not deploy on a schedule. It deploys on a mandate. Institutional compliance teams receive the updated legal framework, issue revised guidance to portfolio managers, and positions are built within the allocation cycle timelines that institutions operate on. That process is compressed and simultaneous across every institution that was waiting for the same legal certainty. Here is the behavioral dynamic that separates the outcomes of the two groups who are currently present in this market, and it is the most important thing I want to leave you with today. Group 1 has been watching the price chart. They have been measuring XRP's value in terms of the daily and weekly candle patterns, the fear index readings, the short-term support and resistance levels. They have been frustrated by the sideways grinding. Many of them have reduced positions or exited entirely during the retail exhaustion phase, providing the supply that institutional accumulation has been absorbing. When the move becomes visible to them, it will be because the price has already moved significantly. Their decision point will be FOMO at elevated prices rather than conviction at suppressed ones. Group 2 has been reading the structural data. They have been tracking exchange reserve flows that confirm supply contraction. They have been documenting the institutional deployment events, BNY Mellon's tokenized deposits, MasterCard's BVNK acquisition, Hidden Road's DTCC connection, the SEC CFTC commodity classification. They have been mapping the regulatory timeline that determines when the permission barriers are removed. They have been holding conviction through the quiet phase, not because they are ignoring the price chart, but because they understand that the price chart is the last thing to update in a permission problem. The biggest gains in every asset's adoption cycle accrue to the participants who understand the mechanism before it becomes visible to the mainstream. Not because those participants are smarter, because they are reading different data. The price chart is a lagging indicator of institutional flows. The institutional flows are a lagging indicator of regulatory permission. The regulatory permission is what has been changing systematically, piece by piece, over the past several months. By the time the mainstream narrative fully reflects what the structural data has been showing, the accumulation phase will be complete. The exchange reserves will be depleted. The liquid float will be contracted. The institutional positions will be established. And the retail capital that was watching the daily chart will be reaching for the buy button as the price is discovering against a supply dynamic that was set in motion during the quiet phase. Here is the complete picture I want you to carry forward from today. Institutional accumulation uses OTC markets that do not appear in exchange price or volume data. The evidence appears in on-chain wallet data and exchange reserve flows, both of which confirm contraction of the liquid float throughout the retail exhaustion period. 32,000 large holder wallets represent an extraordinarily thin supply base against institutional scale demand. Retail behavioral dynamics, holding through early appreciation, selling into momentum, create supply gaps that produce violent price discovery rather than gradual appreciation. The network effect scales with the square of participant count. 100 institutions create 5,000 settlement pairs. 1,000 create 500,000. Each settlement pair has the option to use XRP as a bridge. The demand for XRP as a bridge asset is not linear with adoption. It is exponential. The regulatory barriers that suppress the network below its natural trajectory are being systematically removed. When they are fully removed, the curve accelerates to catch up. The SEC CFTC commodity classification, the Genius Act, and the approaching Clarity Act together constitute the permission system that converts already built infrastructure into fully activated deployment. The institutional capital waiting on that permission is documented at $3 to $5 trillion against a total crypto market of $2.8 trillion. The quiet accumulation phase has the specific on-chain fingerprints it has always had in every major financial assets adoption cycle: exchange reserves declining, large wallet concentration increasing, supply velocity decreasing, regulatory barriers being systematically removed, institutional infrastructure completing. The price chart is the last thing to update. It always is. The structural data updates first, the institutional flows follow. The price discovers last, and when it does, it discovers against a supply dynamic that was set during the quiet phase. Comment accumulation below if you made it all the way through this analysis. I want to see who is reading the structural data, not just the daily candle. Stay patient, stay rational. The quiet phase does not end gradually. It ends when the permission arrives and the circuit closes. We don't wait for the future, we plan for it.